I think with Amazon, AWS, growth and the outlook, what was your read on that?
Well, I think, Ed, the revenue trends across the board were in line with very healthy levels of Q1. So AWS growing at 19%, in line with expectations. I think they're getting incremental growth from AI-related services that they're offering. Probably, we estimate around 600 basis points. And there was commentary that there was very strong demand for their custom silicon, which I think was an interesting takeaway from the call.
Set that in the context, because you are such a great guest to have, because your portfolios don't just own Amazon, but also the competitors in the hyperscale space. What does Amazon's market share look like right now? What does it mean in terms of having its own supply sustainability? Is it less dependent on an NVIDIA, for example?
Yeah, it's a really interesting topical question right now because it has implications for NVIDIA. So Amazon's annualizing revenue for AWS around 110 billion right now, and we'd say Azure for Microsoft, the number 2 players, are about 65, 67 billion. So still a good way ahead, but Azure is growing faster at about 33% versus AWS at 19. The way I think about it, though, is that they're both structurally growing at a very attractive rate, and it's really 2 players moving ahead and Google a distant third. So I think the market share is fine. They're doing all the right things. And in regards to the question about custom silicon, what they did say on the call was that the demand for their custom silicon Inferentia and Trainium was very strong, and that they would be asking their suppliers to increase manufacturing capacity. So that's important because customers do want to have lower cost options. Not everyone wants large language models that use NVIDIA chips. And AWS is in a very good position to cater to that demand and potentially lower cost for their customers.
It's not new that in the context of Amazon, we focus on the cloud business, but there's much more. I mean, what did you make of the e-commerce business, particularly in areas where Andy Jassy has made cuts and scaled back spending a little bit?
Well, e-commerce was extremely impressive on the margin side. If you recall, back in 2Q, they put out a guidance that was below expectations on margins. And the reason for that is, consumers are demanding more daily essentials, and you're seeing lower basket sizes, which means, higher cost to serve. So that entails, that means lower margins for the core e-commerce business. But what they've been able to do to offset that pressure is consolidate more packages into the one delivery, and also leverage the strategy with the regional distribution centers, which has been something in play for the last couple of years, which means that they're closer to their consumer, which lowers their cost to serve, but also that they can increase the number of one-day, next-day delivery items. So it's both good on a customer satisfaction level as well as improving operating efficiency. So margins beat on the core e-commerce side, and I think we now have good visibility for margins to continue to expand at a good, healthy level for the next year or so, despite investing in that business.
I mean, let's take it back to the real investment outlay. A capex of $75 billion being articulated for 2024, and where that then pushes forward to, Ramiz, how much do they have to continue to double down on investment for infrastructure for AI?
Well, the 75 billion is a big step up from the 50-odd billion that they reported in capex last year. So there's already a large step up relating to AWS, Amazon, data center and server-related investment. So will they need to step up incrementally from here? I think it's going to be a lot more moderate going into 2025 versus 2024. But clearly, there is a lot of demand for AI-related services and general cloud. You got to remember that general cloud is recovering as well. And the commentary keeps indicating that there's more demand than the supply that they can offer. So I think they'll continue to invest in capex in this area. But the important thing for investors is that AWS was still able to produce a 38% operating margin, despite the investment we've seen to date. Now, that margin will probably come down, but I think what we can take away is that the margins are probably going to be higher than what people were expecting before this result.